Hello, everyone, and welcome to our webinar entitled State of the Industry, the Hardening of the E&S Marketplace. This presentation is brought to you by Elite Specialty and Wholesale Insurance Services. My name is Luke Hutchinson, and leading today's webinar is my colleague, Greg Lyons. Throughout the presentation, we will break down what it means to be in a surplus lines hard market, as well as the cause and effect of a hard market in the insurance industry. We will then explore what to expect in the hard market and what we can do proactively as agents and brokers to prepare and advocate for our clients. I will now pass the baton to Greg so we can get started.
Thank you, Luke. Hi, everyone, and thanks for joining us. While I understand many of you are aware and also feeling the pain of the current hard market in both the standard and surplus lines insurance worlds, we thought we would break down exactly what we are dealing with on the E&S side and also answer the why behind the current state of the industry. It starts with the 101 foundation of knowing the difference between a soft and hard market. The soft market or buyer's market in insurance can be described as one where there are many financially healthy, solvent insurers available, willing and able to offer broad terms on specific products to meet the insurance demand. This causes insurers to compete with one another on rate and terms, battling to offer the cheapest quote with the broadest coverage. This environment favors the buyer who has plenty of quote options to choose from with favorable, broad coverage and low competitive rates. Up until recently, around the third quarter of 2018, for years we as brokers have enjoyed some of the positive aspects of the soft market, including plenty of carriers available to approach, offering really low rates. Now, things have taken a challenging shift into the world of the hard marketplace. The hard market or seller's market, as you probably guessed, is the opposite of a soft market when insurers become scarcer, scaling back their abilities to offer terms which are generally quoted at higher than average rates. In a hard market, there are not as many E&S carriers willing to offer terms to meet the insurance demand. Some insurers become generally less solvent and financially sound during these times. Carriers once historically profitable in certain lines of business are now exiting or currently placing restrictions on those lines, in some cases even trying different products to regain lost capital. We'll be exploring the causes of the hard market in more detail, but it's important to note that the current hardening of the insurance market has happened gradually over the last couple of years and is cyclical in nature. About every 15 to 18 years, the market has historically hardened. It did so around 1984-85 and again around 2001-2002. It is generally catapulted by economic events and usually starts with one line of coverage, for instance, excess liability or business auto insurance, which can grow and eventually impact an entire marketplace, such as the surplus lines insurance marketplace. We can expect the E&S marketplace to be in a hardened state for at least the next 12 to 18 months as general economic conditions in the insurance industry remain unsteady. This leads us to the next topic. Why are we amidst a hard insurance market right now? What caused the E&S marketplace to harden? There are a variety of factors, the first of which is general economic conditions. Many insurers use their capital reserves to invest in assets like stocks, bonds, and real estate. If the economy takes a turn in any given area, such as the real estate market crashing or a particular stock plummeting, so too can the solvency of some of the nation's leading E&S carriers. The recent popularity surrounding the term social inflation has also been deemed a cause of the hardened surplus lines market. Carriers are seeing an increase in claim activity, and many of their policyholders are drawing out the claims process through lengthy litigation, which becomes costly. Many claims cases are making it to trial, and juries are giving favorable rewards to policyholders filing claims against their insurers, bleeding them dry in legal fees. Because the soft market has also so long allowed for a very broad and coverage form and policy language overall, these broad definitions of liability allow for many settlements in favor of plaintiffs going to court against insurers, which comes at a high price for these insurance companies. Another factor contributing to the cause of the hard market is insurance companies providing rates far below ISO recommended rates for far too long. Now, don't get me wrong, I consider myself a competitive broker that advocates for very competitive rates, but one must reach a point when insuring something at such a low rate becomes a poor underwriting decision. When you underwrite at too low rates for too long, you simply do not have enough premium earned and reserved in the event that you have to deal with catastrophic claims. When catastrophic claims, such as the recent California wildfires or various hurricanes of late, outweigh underwriting profit and investment income, insurance companies find themselves in trouble. Lastly, though happening very infrequently throughout history, current global pandemics such as COVID-19 can produce a major spike in insurance claims development and carrier payout, resulting in the strain of the marketplace, which further expedite market hardening. Carriers are scrambling to figure out how to wrap their hands around a new virus as claims come piling in and payouts start looming. So what sectors of the industry do Luke and I see affected by the current hard E&S marketplace? The first that comes to mind, although we do not play too much in the space, is commercial business auto, especially for any kind of fleet-heavy business or companies in the transportation business such as truckers, haulers, and parcel services requiring full auto liability coverage. This area of the industry has been in a hardened state for going on 2 years now, so it should be no surprise. Many carriers are increasing their renewal rates by astronomical numbers, sometimes up to 50%, or they are even getting off business auto policies and pulling out of the space altogether. The business auto market is really challenging to navigate right now. The excess umbrella market has also taken a toll as a result of the hard market. Insurers are shy to offer lead positions higher than a few million, and they are offering less capacity overall, even as layers. The days of $10 million lead excess and finding $50 million from one or two carriers is over. The good news is, overall, there's no shortage to find capacity with multiple insurers. General liability overall has experienced pain in certain areas. The construction arena, for both practice and project-specific submissions, is experiencing rate increases overall. Not drastic increases, but some carriers are trying to get anywhere from 5 to 10% more rate, more than they usually would on commercial and residential construction quotes. Not to worry, this won't happen under our watch. Other businesses experiencing stress in the GL world include those that work in brush fire or wildfire prone areas or wind and hail areas, since late catastrophic events have caused premiums and rates to rise. I will let Luke speak to the professional line side of the E&S world. Luke?
Thanks, Greg. Management and professional lines have not been spared in the hardening market. Historically low rates coupled with rapidly increasing claims verdicts flavoring plaintiffs have been pushed carriers' combined ratios well over 100%. Additionally, classes of business that historically have been considered low hazard are now forcing carriers to rethink their stance. These classes include some of the hardest hit during the initial stages of the COVID-19 pandemic, including restaurants, manufacturing, and airlines. As a result, carriers are increasing rates anywhere from 5 to 25% on clean risks and in the triple digits for those with recent claims. Beyond rate increases, similar to what Greg mentioned in casualty, capacity is becoming an issue with carriers cutting their limits by up to 50% at renewal, forcing agents to look for multiple carriers just to offer expiring limits. Trends we are closely monitoring include social inflation and nuclear verdicts due in part to litigation funding, shareholder claims tied to inaccurate revenue projections, and executive liability claims resulting from decisions on how businesses reopen following lockdown orders, including which employees they elected to lay off or furlough and bring back. Contract tracing, employee screening, and constantly evolving legislation will also cause many underwriters to lose sleep at night as we navigate through the next 12 to 18 months.
Thanks a lot, Luke. One of the tasks involved in navigating the hard market is knowing what to expect. Stricter terms and conditions from carriers for both new business and renewals is something to anticipate may happen. For example, during the renewal process, a construction underwriter may place a different, more restrictive new residential endorsement on a renewal quote for a contractor that does new residential work if they know their policyholder is not doing a certain type of new residential work that has not otherwise been excluded on their policy in the past, just so the carrier can tighten the scope of coverage. Increased rates and premiums should be expected, although not across the board and not always severe. Conditional renewal notices and even non-renewals are also happening in today's marketplace. Carriers want to review renewal business for changes in rate premium and also to make sure coverage is correct, sometimes in an effort to see if they can revisit to narrow coverage in any way by excluding more unnecessary coverage while still offering everything the policyholder needs to operate. To the point of non-renewals, as mentioned previously, you can expect certain insurers to pull out of products they have historically offered for a long time due to poor loss development. One positive idea to keep in mind during a hard market is that when one door closes, usually another door opens. We should start to see new insurance companies emerging over the next year, offering lines of business other companies have left. The last item we want to go over is how to navigate the hard market and protect your clients. The first way to navigate the E&S insurance market is to be informed and aware of its current state. Well, we've already done that for you, so you can check that off the list. Start your renewal processes early and be prepared to explain to your new and existing clients the current state of the market so you can help them understand the difference in coverage and perhaps soften the blow if they have an increase or revised terms imminent. If 90 days is your normal renewal follow-up time, think more like 120 to 150 days out, especially if you feel you are working on a risk that may experience issues being renewed or placed. Next, carefully review renewal and new business terms, even when they are from well-known markets you have used before and trust. Markets you may have worked with in the past could have changed their terms, conditions, or pricing if you do not read the fine print carefully. When negotiating terms with wholesale brokers or carriers, take a more active and strategic approach when having discussions regarding pricing, terms, and conditions. Really fight for your clients. Last but not least, be sure to choose E&S business partners that have concrete knowledge of their surplus lines products, who can confidently and effectively provide you with various quote options, and who will take the time to explain to you the differences in coverage and pricing.
This concludes our presentation for today. Thank you so much for joining. We hope you found the content useful. Feel free to contact Greg or myself should you have any questions at all. And until next time, have a great day.
Thanks, everyone.